Okay. So here's our disclaimer here. Just want to give a chance to anybody who is going to have this recorded back that they can see that disclaimer. But let's go ahead and get started in here. So our very first thing is we're going to be talking about required minimum distributions. So Crystal, what is a required minimum distribution or RMD?
So a required minimum distribution is the amount that must be withdrawn from an employer-sponsored retirement plan, traditional IRA, SEP, or simple individual retirement account by owners and qualified retirement plan participants who are of retirement age.
Okay, so can I take more than the required minimum?
Absolutely. You can always take more. That minimum is just what the IRS is requiring you to take out.
Okay. And so what happens if I have an account here with Mountain West and I have another account and I'm at retirement age, and so I have two RMDs essentially?
So you can either take an RMD from each account, or you can combine the two RMD amounts and just take them from whatever account you want. As long as it's a retirement account, you can combine them.
Okay. And so how are they calculated?
So the RMD is calculated based off of your December 31st market value divided by a factor from the IRS life expectancy table.
And where does the IRS get that? Like, where do you find that? Where would you find that?
The IRS has a life expectancy table on their website. They have a factor for essentially each year. So you would find the factor for your age and divide your market value by that factor.
So essentially anybody could see at the end of the year what their RMD would be for the next year. All right. So who's required to take these?
So require account owners of the below types of accounts who've reached the age of 72 or have an inherited IRA, meaning you inherited an IRA from someone who has passed, you were their beneficiary. That would be traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403b plans, 457b plans, profit sharing plans, and other defined contribution plans. Also with an inherited IRA, if they had a Roth account that you then inherited, even though it's a Roth and you normally wouldn't have to take required minimum distributions, once it becomes an inherited IRA, you do have to take them.
Okay. So a Roth account, if it's just a Roth account that I have, do I have to take required minimum?
No. So if it's your own Roth account that you've started, that you've funded, you don't have to take them. But if it's a Roth account that you started and you funded and then you passed away and it went to your beneficiary, they then have to take required minimum distributions. Okay.
And so you mentioned age 72. I thought it was 70 and a half was the.
So it was 70 and a half up until the Secure Act in 2019. At that point, they moved that to 72 if you had not yet started taking required minimum distributions.
Okay. So let's say that my spouse dies and I inherit that IRA. Do I have to take one then?
So if your spouse dies and they were already in a status, they were already old enough to have to start taking required minimum distributions, and they had not taken that for that year, you would have to take it on their behalf. Otherwise, if it's going to like a beneficiary account, you start taking required minimum distributions by December 31st of the year following the year of death.
So if I inherit a traditional account, my spouse passes away, I'm the primary beneficiary as a spouse, but I'm not of RMD age, do I have to continue taking them?
So if you have put it into a beneficiary IRA, yes, you would have to continue taking them for that year following the year of death. The spouses have different options when it comes to beneficiaries. And so depending on your circumstances at the time, you may not be having it, you may not have put it in a beneficiary account.
Okay. So, and I may have just been able to treat that as my own account.
As your own, yes. And at that point, it would be You know, if they were already RMD age, you'd have to make sure it got taken for the year they died. But if you weren't 72 yet and you're treating it as your own, you do not have to take RMDs until you reach 72.
Okay. Good to know. So when are they due?
So RMDs are typically due by December 31st of every year. However, for that very first year you have to take them, the IRS has built in an exception to where you have until April 1st of the following year to take it. And then going forward, they will always be due December 31st.
Okay. So what happens if I take less than the required minimum?
So if you take less than the required minimum, when you go to do your taxes, you'll have to indicate on your tax forms, you know, the amount you took out. And the IRS is going to end up penalizing you if you did not take the amount that you were supposed to. That penalty will be 50% of the amount not withdrawn.
Okay. So if you even $1, you are short $1.
You're paying them 50 cents.
Okay. And if I miss the deadline completely, let's say it's January 1st and I say, oh, I forgot to take this. Can I?
So we're always going to recommend that you speak with a CPA or tax advisor and consult with them to see what they would suggest you do. I've had some who come back and say, hey, go ahead and take it now. We'll try and get the penalty waived. I've had some who said, hey, don't worry about taking it. We're just going to pay it.
Oh, okay.
So it's always going to be a discussion with your CPA or tax advisor to see what would be in the best option for you.
Okay. So we spoke about beneficiary accounts. Is that still January 31st, like the year they die that you'd have to take one?
December 31st?
Sorry. Yes. Sorry. December 31st. Yes.
Yes. So you have to start taking required minimum distributions the year after, by the end of the year following death. So if they had died in January 2022 and let's say they had satisfied their RMD for 2022 at the point that they died, you would not have to start taking an RMD until 2023. However, if they had not satisfied their RMD that year, you'd have to take one in 2022 to satisfy that on their behalf, essentially. And then you would have to take required minimum distributions every year going forward.
Okay. Okay. So potentially you could have 2 distributions you have to take basically in that 1 year, because you have to satisfy that.
Mm-hmm.
Okay. Makes sense. Okay. So I think that covers that for RMDs. How do you take one?
So for us, you would fill out our distribution form and you'd send it back to us. We typically would process that 3 business days later and get the funds to you in the manner you selected.
What different types of, can you select?
We can send you a check for those funds. We can do an ACH. We can do a wire. If you don't have funds available to take your RMD, we could go through what's known as an in-kind distribution, to where we're distributing these assets to you personally. That can be a bit more intensive, and there's some different documentation required for that. So you would certainly be welcome to give us a call, and we're happy to go through what we would need to do that.
So do I have to take cash, or can I just take an in-kind distribution?
It would be completely up to you. Even if you have the cash in the account, but you have an asset that you want to own personally, you can certainly take the asset.
Okay. So let's say that I'm going to take the cash that I have built up in my account for my RMD. Do I have to take it personally, or can I send it to like a charity?
You can send it to a charity. When you're filling out our distribution form, there's an option for like who to make a check payable to. Okay. And if you're wanting to do what's known as a qualified charitable distribution, you would indicate in that section who to make it payable to, where to send it. And then you'd want to make sure that when you go to do your taxes, you work with your CPA or tax advisor and say, hey, this was a qualified charitable distribution, because oftentimes when you do the qualified charitable distributions, those are not included in your taxable income.
Oh, okay. So with this being, generally the RMD is included in your taxable income. Do I have to withhold taxes when I take this?
It is up to you. You can elect to not withhold taxes, or you can elect to withhold 10% or more. You can't go in between them right now.
Okay. Awesome. Well, that's good to know. So it's either 0 or 10% or more for that one. Okay. And then, so is this like a form that I have to fill out every year? I know I'm going to be taking my RMDs every year. Do I have to fill out a new form every year that I do this?
It depends on how you fill out the form. So if you want to manually fill out the form to take just your RMD amount every year, you can, or you can fill out the form and just indicate an RMD and mark it as an annual distribution for us to automatically send your RMD amount every year on a specified date.
Okay. And that will vary, obviously,
Correct.
year by year.
And so in that case, you're not actually putting an amount on the form to take out. You're just putting RMD, and then you'd continue filling out the form indicating whether or not you want taxes withheld. And then we would just automatically take your RMD amount every year if you do it that way.
Okay. That's a good option to have. So with that, how are they reported, the distributions?
So all the distributions are reported on the form 1099-R, which gets sent to both you and the IRS.
Okay. So that's going to lead into, so you said form 1099-R. What is this form?
So the form 1099-R is one of a series of 1099 forms that's considered an information return and reports various types of income that is not considered to be salary. These are used by the IRS to keep taxpayers from underreporting on their income. They're generally issued by your plan issuer, and for IRAs, that would be the custodian of the IRA. They capture distributions and the nature of the money being distributed, meaning what type of account the money came from. And it also uses multiple numbered and lettered codes to let the IRS know what type of distribution it was. Were you over 59.5 and this is a regular normal distribution? Mm-hmm. Were you under 59.5 and it's an early distribution? Did this come from a Roth account? Was this cash? Was this an asset? Those are all things that are in a way reported on that form to the IRS.
Okay. All right. And so is this 1099-R, is this the same kind of thing as a 1099 miscellaneous?
No, so the 1099 miscellaneous, typically we see that when it comes to like rental income. The 1099-R specifically deals with distributions from retirement plans. Okay.
So who would get a 1099-R?
So any account holder would receive a 1099-R if they had a distribution over $10, if they did a rollover from one IRA to another at any point, because that starts out as a distribution, or if they did a conversion from a pre-tax account like a traditional IRA to a post-tax account like a Roth. Those start out as distributions as well. So you get a 1099-R for those.
Okay. All right. Would I get one if I took a participant loan from my 401k?
No, so participant loans aren't considered to be actual distributions. They're more like investments. Mm-hmm. And so if you have a 401k and you take out a participant loan, you do not get a 1099-R for that.
Okay. So I wouldn't be on the lookout for one of those.
Correct.
Okay. So would I still get one if I distributed the asset, like you were saying, the in-kind?
Yes. So if you distributed the asset, you would get a 1099-R at the value that was distributed.
Okay. And let's see, when does this get sent to the people, the clients?
So 1099-Rs are required by the IRS to be sent to clients no later than January 31st.
And I get this in the mail?
No, so we will actually, instead of mailing them out, we will upload them to your client portal. You'll get an email that you have a new document to view. That way you can print it out. If you lose it, you can go print it out again. You're not having to call us and get copies of it, or it got lost in the mail. It's right at your fingertips.
Okay. So that's one reason why it's good to have that portal and be able to get in and see everything in your account. All right. So what do we do with it? Once we have it, you've issued it, what do we do with those?
So if you have received a 1099, You will actually need to include this with your federal and state income tax returns because you're going to file it with them because it includes information on your taxable income for the year.
Okay, so I do need to, am I required, so I am required to file that with my tax agent?
Correct.
If I get one. Not everybody will get one.
Not everybody will.
Okay. Awesome. Well, with that, we have another form, which is a form 5498. Can you kind of go over what that is?
So form 5498 is really an informational only return. The IRA custodian or trustee is responsible for issuing this both to the IRS and providing a copy to you.
And then, so who would get one of those?
So every IRA and deemed IRA owner will receive a 5498. A deemed IRA would be an employee contribution plan set up as a traditional or Roth IRA that are tacked on to an employer's qualified retirement plan. They're not 401ks, but they're kind of still part of the plan.
Okay. So they would get one of those as well.
Yes.
Okay.
And then this form captures and reports contributions, rollovers, conversions, required minimum distribution amounts, and the year-end fair market value of an account.
So in other words, an FMV.
Yes.
Lovely FMV.
Yes.
Can you explain what is an FMV there?
So fair market valuation, because we're required to report this on your form 5498, it means we have to have an updated value for all assets to be able to report that. The way we do things, instead of having every client submit an FMV in December, is we go on a rolling 12-month basis. So you have to give us an FMV 12 months from when you purchased the asset or last provided a fair market valuation. That may mean that you gave it to us in May. You're not going to be required to give it to us until May of the following year, but that value you gave us in May is going to be what's reported to the IRS on the 5498.
Okay. And that, so let's say that I purchased the asset in May. So it's not going to be due until the following May. So that means what that purchase price will be what's reported on that. Okay. And then, so what happens if I don't get it to you? Like this is required by the IRS. So what happens if I don't see your emails or I spaced it? My bad. What happens?
So we make every attempt we can to reach out to clients regarding these fair market valuations. You get emails in the months leading up to the valuation due date. So you get 3 emails. If, say, your valuation was due in December, you would have gotten an email in October, November, and you would get one in December. And those are generally due by the end of the month. If it was due in December and we didn't see anything, come January, you're going to get a letter from us in the mail saying you have 30 days to give us this valuation or we're going to have to resign. And before those 30 days are up, you're going to get at least 2 phone calls from us trying to get this valuation. If we don't receive anything, if we cannot get in touch with you, we can't get the valuation, we're going to end up resigning on that asset, which is an in-kind distribution of the asset to you personally. And whatever value we last had that asset at is going to be reported on the 1099 for that calendar year.
So then that's added to your taxable income for the year. Okay. So very important to get those in so that doesn't happen. I had a question for you, but I just faced it. So so it obviously, we want to, another point is you mentioned we are trying to contact you. So the importance of having updated address, phone number, email. Is it mainly emails? You said they're contacting twice and you're emailing 3 months prior. So
we're sending you 3 emails. We're physically mailing a letter and then we're calling you twice. And if at that point we still don't get anything, when we actually do the resignation and we mail those documents, we're sending it certified mail. Mm-hmm. So we are trying everything in our power to reach out to you to get this, because the last thing we like to do is resign on these assets. We would much prefer to work with you or maybe make an extension if we need to on that time frame rather than giving you a distribution you probably don't want.
So it's the no contact that really can mess up an account, really, like just not having any contacts. We're always willing to work with people, and because obviously everybody's situation is different. So that is very good to know. Let's go ahead and move on here. When do we get these Form 5498s?
So 5498s have to be to the client and to the IRS by May 31st each year. This deadline is later in the year than most forms because it's going to include any prior year contributions that were made to your account. So you have up until the tax filing deadline to make a contribution for the prior year. So typically once that tax filing deadline passes, we wait a couple weeks, make sure we've got any last minute contributions that are applicable, and then we start generating these and getting them out to clients.
Okay. So tax filing deadline, the last few years have been kind of wonky with the CARES Act and everything.
Mm-hmm.
So that could be whatever the IRS is deeming as that tax filing deadline.
Correct. And so typically if they push out the tax filing deadline by several months, they're also going to push out that 5498 filing deadline.
So you should generally, if that happens again, say this does happen for some reason, you could expect that to come out within the next month, really.
Yeah.
Come out by the end of the next month. Okay. And then is this sent by mail?
No, this again is uploaded to the client portal. So again, you'll receive an email saying that you have a new that you have a new document to view, so that it's right there for you.
Okay. Let's say I did a rollover. Am I supposed to report this for taxes? Or how am I supposed to? Sorry. How am I supposed to report this if it's I did a rollover, I need to report this for my taxes, but that form doesn't come out until after taxes are due. So how do I report that?
So what you're going to do when you go to do your taxes is you're going to have your 1099 form already showing the first part of that rollover, the distribution. You're not going to have the form 5498 showing the rollover. What you will have is a year-end statement. And that year-end statement is going to show that rollover or conversion transaction. And so when you go to do your taxes, you'll work with your CPA or tax advisor, say, okay, here's my 1099, but I put this money in another IRA, and they will work with you to make sure that it's documented appropriately so that you're not depending on the situation, whether or not you should be paying taxes on that.
Okay. So there is a way to do that without, so don't freak out if there's, if you're not getting your 5498 before then. So once we have, it was sent out, what do we do with it at that point?
So you should usually just keep these with your tax records, because by the time you get it, you've already filed your taxes. You're not going to return this. You're not going to put this with your taxes when you go to file.
Okay.
If you filed for an extension, you'll have it, but you don't have to return it with your tax return.
So should I even give this to my CPA or financial advisor?
You would want to give it to them so that they know what you've done, because it's going to show them any contributions you made. And you may have forgotten to tell them you did a contribution. This form is going to show that to them. It's going to show them what they need to know you did with that account. Okay.
So it really just captures pretty much everything that kind of happened with the account there. Between the two, the 5498 and the 1099, that's going to show pretty much everything with your account at that point. Yeah. Okay. Well, thank you, Crystal. So that is all we had presenting for that. Key points when you hear RMD, that's required minimum distribution. FMV is that fair market valuation. You'll see those terms when you speak to somebody here at Mountain West. So if you're ever confused about that, that's what that means. We're going to go ahead and open it up to questions right now. Let me open up the chat head here. Let's see. So we have from Eugene, this year, my market value was done using the county property assessment as of December 31st, 2022. If I need to start taking RMDs next year, do I need to get a professional paid property assessment before withdrawing that RMD for the next year?
That is a good question. The answer is no. So you can use that property assessor value to give a value to that asset, and that's the value that will be used to calculate your RMD. The only time you need to actually get a paid professional appraisal is when you're doing a taxable transaction specifically with that asset. If you're distributing that asset to yourself, or if you're converting that asset from a traditional to a Roth account, at that point, you have to get the appraisal. But if you're just getting a value to us to meet the requirement for a fair market valuation, you can certainly use the property assessor.
Okay. So kind of the key word there is if it's a taxable event, we need to make sure we have the most accurate value of that property. Okay. Thank you. Do we have any other questions? Let's see. We're just going to leave it open here for just a minute to see if anybody can think of anything else. And everybody will be able to have a copy of this presentation, so you can go back and hear if you have any questions. You feel free to email us, and we can always answer those as well. But you can always revert back to this too if you want to. If you missed something that was said, you will get a recording of this, so you can go back and review it. Let's see, we have another one. So I cannot use the property tax assessment if I withdraw RMD into my name.
So it depends on how you're taking the RMD. If you've got cash in your account and you're just going to use the cash to satisfy your RMD, absolutely use that property assessor statement. If you're withdrawing the actual asset, if you're distributing that property to yourself, or converting that property, that's when you need the appraisal.
And that's any percent of that property, correct? So even whether it be 100% or 10% of that property, you have to have that appraisal. And then what's the date? So let's say I did this 7 months ago for the year to update my FMV. Can I use that at the end of the year to take my RMD?
7 months? No. So if you're wanting to do a taxable distribution like that, to where you're wanting to distribute the property, that appraisal has to be dated within 6 months. But that means, let's say that you've got a property that you're wanting to own personally, but you don't want to take the tax hit all in 1 year. You want to spread it out over 2 years. That means you can do an appraisal in, say, October. And you can use that appraisal value, distribute half of that property in that tax year. And then in January, say, hey, I need the rest of that property. Our appraisal is still good because it's still within 6 months. So we just distribute based on that value.
Okay. That's a little bit less of a hassle there if you do it that way. That's a little trick. Thank you for that one. So that means for next year, I have to have a professional appraisal done before withdrawing the RMD for next year.
No. So only if you're going to withdraw the asset itself. If you're just going to withdraw cash, you don't have to have that appraisal.
Okay. So if all you have in your account is that asset and that's your only option is to take that, then yes, you would have to have that appraisal, official appraisal done. Okay. Did that clear things up, Eugene, for you? Give it a little bit of a lag time sometimes. Do I have to do that appraisal before the end of this year?
If you're going to be doing a taxable event with that asset. So it depends on what you're doing. Are you working directly with the asset? Are you wanting to distribute that property? Or if you're just going to do cash, you don't need to worry about the appraisal.
Okay. So I'm going to play off of his question here, just kind of give it a scenario here. He does an appraisal at the end of this year. He can use that if he wants to distribute next year for his RMD. That will be good because you're within that, as long as he does it within that 6 months timeline.
If he's wanting to distribute the asset, yes.
Okay. So you can roll that kind of over into the next year if you play your cards right. Okay.
Okay. So yes, if you're wanting to distribute the property to yourself next year, you'll have to do an appraisal dated within 6 months. It doesn't necessarily have to be done by the end of this year, but you'd have to do an appraisal dated within 6 months of doing that distribution.
All right. Well, it looks like we answered that question for you, Eugene. If we have any other questions, also, if anybody has any topics you guys would like Mountain West to do kind of a webinar on and, go a little more in depth for you, send us an email. Let us know what we can help you with and give you a little bit more education on. Like I said, we record these, so you are always welcome to go back to these. And if you have any questions, we're always looking for new things that we can help you guys with education on. So our email's there on that screen for accounts at MWIRA. If there's a compliance question, such as what we just went over, that's compliance at MWIRA. And we were always happy to answer what we can for you. All right. So we're going to go ahead and wrap this up. Thank you all for joining us. And like I said, if you have any other questions, feel free to email us. Okay. All right. You guys have a good night.